could be catching trades like this aiming for 15k profit if you actually understood how supply and demand trading works in Forex. And with prop firms blowing up, you could definitely be doing this too. So in the next 27 minutes, I'll show you the simple logic behind supply and demand, how to enter and exit trades properly, my full strategy reveal, and live trading to back it all up. So let's begin. Okay, so what is supply and demand? In the simplest way possible, is pretty much a roof and a floor for the candlesticks. Now, why are these levels so important? Is because the institutions and big banks are actually looking at these levels. They don't trade random trades like this, somewhere in the middle. They don't do that. They wait for these levels to be hit. So they are formed here. 1, 2, what do we expect the supply zone to do? Well, of course, to trend towards the downside and hit our demand areas. We can see huge spike towards the downside. These big candlesticks show aggressive selling. Trust me, you as a trader, me as a trader, we don't have enough money to move candlesticks like this. It's the big institutions, the banks, JP Morgans. These are the guys that actually trade and move the market. So we want to trade with them. After the demand zone is hit, what do you think happens? The price respects it and starts pushing towards the upside, and this continues until there is a eventual breakout, because the banks did what they wanted to, the orders have been filled, they made their money, and then they continue the trend. So you can just imagine the advantage you have as a trader once you know where the supply and demand actually is every single time. Even if you enter the trade here for a sell, this could have been a beautiful trade because simply it respected the supply level. To simply put it, the banks and institutions are always trading in between a supply zone and a demand zone. And if you know where they are, you can pretty much predict where the market is going to go next. So how do we actually identify supply and demand zones before they are fully developed in the market? Well, we first want to find a swing high that was previously rejected and a swing low that was previously respected. This kind of candlestick price action gives us a reason to mark potential supply and demand areas. Something like this will do, bam bam. However, it's called the potential supply and demand zone for a reason, because we cannot trade it just yet. We need the price action to actually touch it a few times before we can confirm there is institutional buying and selling pressure in these areas that we marked. That will be the key to our success when we want to follow big money in the market. And as you can see, the candlesticks finally retested our potential supply zone, and if it rejects, which it did over here, it already confirms that there's a lot of selling and buying pressure in around these two area zones. So let's just see where the market is going next. A bearish engulfing candlestick is a great indication for a lot of selling pressure. We could sell the trade off, and let's see what happens. The institutional pressure does push the market further down. So now the same thing can be said for the demand zone. If we have a look at the candlestick formations, every single candlestick clearly stayed inside the demand zone, and eventually we broke out into a new high with that bullish candlestick. This is a great indication for buying pressure. So something like this will do. We could potentially buy this position, and the market eventually pushes towards the upside and hits our target profit. So this is the simplest way to identify supply and demand. The potential supply becomes a supply. The potential demand becomes a normal demand zone after it actually touches and respects it a few times, right? After that, you can start trading and making money this way. However, sometimes the markets are just unpredictable. So how do you prevent this from happening and not get faked out? Because fake outs happen all of the time. Let me give you an example. So if we move a few candlesticks forward, we can actually see that the candlesticks broke out our previous supply and demand area. What does this mean? Is this a fake out or a breakout? Well, if we look at the higher time frames, such as the weekly, we can see how the candlesticks reacted. Yes, there was a push towards the upside, but it failed to break the previous supply and demand area. And this over here, this rejection confirms that there is still a lot of institutional selling pressure. So what you could do is not be scared and enter a trade one more time, even though there is a strong push towards the upside like that on the daily, because the weekly is the higher time frame, and typically you want to follow the higher time frame bias rather than the short-term lower time frame trend. So you could have potentially shorted this trade one more time And if we are lucky, it would have been a very profitable one. With these simple techniques, you will be able to identify correct supply and demand areas which won't fake you out and potentially make you a lot more money. All right, now we're going to talk about important supply and demand formations. There's 4 of them. The first one is supply and demand formation, rally, base, rally. This is what it looks like. But since I've been trading for 10 years, I have a lot of experience and I can show you different ways to actually trade this rally, base, rally without, looking picture text perfect, because there's nothing text perfect in trading. So what do we have here? Look, there was a push towards the upside, but we don't really have the horizontal area of sensitivity. As you can see, it would have been broken out and it doesn't make sense because, there is nothing coming back, to the supply and demand areas. So what do? We can actually use a nice little channel. Look, it's going towards the downside and it pretty much is the supply and demand area, just a little bit rotated. So what now? There was a push towards the upside. It hit the ceiling, right? And the price has been dipping down. So what can we do? What can we wait for the candlesticks to do? Tell me. The price to actually push and break out that channel. The rally happened here. This is the base of the supply and demand, right? There was a push towards the upside. So push, what do you think is going to happen? An exhaustion back where? To the previous area of supply and demand, right? In this case, it's a little bit rotated, but it doesn't matter. So what do? We wait for a pullback. The pullback happens, as we can see over here. This is the wick we would want to enter our trade on. The stop loss covers the first area of supply. The supply becomes the demand, by the way, as well, and we could enter this trade, and this trade would have been beautiful. So this is the first formation. I know it's not perfect, but this is how I would trade it. I don't want to show you just textbook examples because it's so easy to just draw lines and imagine that's how the markets move, because it's not realistic, right? This is why I'm not cherry picking. I'm just showing you what I would trade myself. So the second supply and demand formation, drop base drop, meaning there is a drop, usually a consolidation, and another drop. As we can see, an alien appeared out of nowhere, making this huge bullish engulfing candlestick. Then it disappeared, then it started to consolidate. Nobody knew what happened. Then eventually, boom, it actually broke out towards the downside. Since it's trending towards the downside, it's a bearish, formation. And as we can see, we are expecting a continuation. So push exhaustion, push is likely what happens next. So let's see. Boom, goes towards the downside, and exhaustion back to the previous area where the demand zone, this demand zone becomes not a demand zone anymore, but a supply zone, and it continues dropping down, or hopefully it does. And there we go. It continues dropping down. This formation is bearish. It works the same way as the bullish one we previously talked. So that's why I'm not covering it in depth. The third formation is rally based drop. So very simple. We have strong push towards the upside. We start a consolidation phase where we start marking our supply and demand areas. For the formation to be complete, we need a strong push towards the downside and a pullback towards the upside. So if we can get this just over here, that would be perfect. As you can clearly see, the demand zone is broken and it becomes a supply zone. This is where we can enter a trade short. So somewhere over here, stop loss just above the previous wicks, and the target profit can be the top and bottom of the supply and demand consolidation level. Since this is also a rectangle chart pattern, which is a little bit different, and I teach in some of my other videos, you can target your take profit this way. And this looks like a great trade. 2.22 risk to reward ratio, meaning if you risk $100, you would get $222 back if this trade is successful. And if we took a sell on this trade, let's see what happens. It drops down nicely, and this would have been a beautiful rally based drop formation. Okay, so our last supply and demand formation is drop base rally, which means it's dropping down, it's consolidated, and it should start rallying if it breaks out. So let's see what happens. It breaks out. 1 2 3 4 5 and 6. Look at this push, exhaustion cycle, right? This could have been a beautiful trade towards the upside. The moving averages are pretty much nearly crossing now, and also we could potentially use a Fibonacci line. Look at this 0.5 golden level over here. This could be a good trade. So if we long this position, stop loss has to be covering the supply area zone. So as you can see, the stop loss is a little bit lower, and there we go. Target profit maybe somewhere over here. 1.85 risk to reward. Maybe you can make it even a little bit bigger if you want, and then boom, it should continue going towards the upside and make you money. It's pretty much the same supply and demand formation like the last one, just in reverse. Right, enough of price action formations. We need to learn now how to enter and exit trades with supply and demand. I believe this is the easiest way, so let's discuss it. First, you want to find some sort of rejection. So something like this, it's pushing towards the downside, there is a rejection here. Pushing towards the upside, there is a rejection here. This is not where we enter and exit trades. We need the supply demand to be established first before we take the trade. Now, if you've been listening, this is the drop base drop formation, or at least it's currently trying to be. So as we can see, the market is pushing towards the downside and consolidating. We are expecting at some point that this trade will continue dropping down. So because we know this, how can we enter and exit trades profitably? Well, first thing, it's following a downtrend at the moment. So we could enter our positions not here because we need it established, but potentially here if you wanted to, but you're trading against the trend. So it's risky. So what I would do is enter positions something like this, here, and here. So 3 potential opportunities for drops, and you can potentially have small stop loss and big risk to reward ratio. Look at this, 283 every single time, and we could triple this. This is totally a reasonable way to trade supply demand, nothing complicated, easy as that. However, if we want to trade the formation breakout that we talked about, so in this case drop base drop, we want to wait for the breakout. So 1, 2, 3, 4, 5, and 6 is breaking towards the upside, right? What happened over here? It's breaking towards the downside, then pulling back towards the upside. This is the ideal scenario we want to see. Back towards the demand area, which becomes a supply area, so a ceiling instead of the floor, because the floor was broken. And you could simply enter your trading position this way. Your stop loss has to be just above this area zone. However, to make sure it actually doesn't wick you out, you want to use the moving averages as well. I like using these ones, and as you can see, just above the moving averages is a safe spot to kind of 60 pips. I would say that's pretty damn good. Now, because we're trading the formation, for the take profit, we want to measure the box. So the high and low of the box, which is around 125 pips, you want to trade the breakout. So something like this is great, and then you simply measure your target profit this way. It becomes 1 to 2 risks to reward, so we're risking $100 to make $200, and as we can see, eventually it does drop down. So this is the easiest approach to trade supply and demand. You know, you can either trade from the ceiling to the floor depending on the market trend, or you can trade the breakouts and formations I showed you earlier on. As long as you have a lot of confluence with supply and demand, these supply and demand areas become high probability instead of just meaningless boxes on your charts. Okay, so listen up. We're going to talk about common mistakes, and trust me, don't skip this part because it's probably the most important part where most traders make mistakes. So listen up. So first thing, drawing supply and demand incorrectly. So some people like to use line charts. It could confuse you. Why would you use line charts? It's a zone. It's not a line. It's not a price level. It's not an exact level that it's gonna, continue moving up or down. As you can see, there was a breakout here. Use zones. Bam, bam. Nothing was broken. Everything is being respected. It makes sense, right? Another mistake I see all of the time is just drawing them wrong in general. Drawing something like this, in the middle. Why would you draw this in the fucking middle? It doesn't make sense, right? You want something obvious. If you can't spot it, don't draw it. Something like this, the nice, push, consolidation, drop, exhaustion back to the previous area sensitivity, it's always there. Whether you're looking at the daily time frame or the 4-hour time frame, there is still small supply and demand areas or big supply and demand areas depending on the time frame you look at. Of course, the higher the time frame, the higher the probability, the area, because institutions typically trade at least off the daily time frame. So once there is a daily breakout, that is a pretty damn good confirmation. Once it's a weekly, it's even better. And pretty much that's how you kind of reverse engineer your trading before you enter the trade. Another common mistake I see is just not trading with the trend. Trade with the trend always. When you're trading supply and demand, use moving averages. I really like using moving averages because it's a simple indicator that shows how price reacted, through the average. Moving averages, that's what the price is doing. So if we take a look, supply and demand zone over here, bam, bam, we knew that there was a breakout over here. We knew that there is that formation coming up, right? Rally, base, boom, drop, right? And it's currently trending towards the downside with all three indicators. Look, a crossover, this is a depth cross, 50 and 200 moving averages. It's a great trading opportunity. It's high confluence, right? Push exhaustion. This is where you enter your trade. Bam, you go towards the downside. You know, you mark again the previous price range. Boom, 270 something pips. So let's see if he achieves it. Boom. There we go. All right, now let's move on to the last supply and demand mistake, which is too close entries. What do I mean? So we currently have the moving averages. We had a nice push, base, push, right? But we didn't have that exhaustion, right? So maybe you want to actually trade this previous area of supply and demand, right? So let's say you entered your trade over here, it's going towards the upside, you're happy, and then boom, it goes towards the downside and actually hits your stop loss level. Why? Well, sometimes your entry is just not close enough to where that main action is, and as you can see later on, he actually goes towards the upside, and I believe he actually hits our target profit level. But what you could have done is maybe used a Fibonacci level. Look at this, Fibonacci over here. This gives you a nice understanding on where the market will likely turn around. 618 and 05 levels are the main ones to focus on. However, this is not the main thing. What I wanted to show you is actually the weekly. Look at the weekly time frame. What's currently happening? This is actually the main area of action, right? This was the previous supply zone that became demand, right? This is the 618 Fibonacci level. This is where the crossover of the moving averages happen. This is where the action happened, not here. There's no action here, right? This is just empty space, right? There's a gap in between, you know, where you entered and where the main action is. And if you're not careful enough, you're going to be entering trades, get stopped out like over here, and then see your trade actually go inside your profit, which will piss you off more than anything, because there's nothing worse than entering a trade. It hits your stop loss just by a few fucking pips, and then it moves 200 pips towards the upside or towards the side you thought it would. Trust me, it's an annoying thing. Try to prevent this from happening with high confluence trades. So combine supply and demand and indicators, and I'm going to show you how with my own personal trading strategy right now. Okay, so finally we're here. I'm going to reveal my personal supply and demand trading strategy, the way I use it all the time. And I'm going to show you on a random, not perfect chart, so it all makes sense because trading is not perfect. So what do we want? We can see that there is a rally and a consolidation zone. So rally, base, right? I know it's slided. I know it's not straight, horizontal, and straight, but that's textbook. This is not what I'm teaching you. I'm teaching you real-time supply and demand charts. So push, bam, bam, bam over here, you know, first, second, third touch, right? Since it didn't touch 2 times over here, I would probably start looking at this supply and demand zone seriously after this touch only. So this could have been a potential buy zone. As we can see, this could have been a potential sell zone. And it continues moving up and down every single time, right? But this is not the point. You know, we are not using any indicators, and we really should. So what I like to use is the moving averages. And as we can see with the moving averages, we can spot where there was a huge supply zone, right? The supply was it. Boom, look at this huge candlestick. Institutions took this trade, boom, dropped down. Look, it's kind of going up slowly, respected the moving averages, went down. So we know that the institutions are there, the smart money is there, and is pushing the market every single time towards the downside. So now, if you're like me, I'm a little cautious. I wouldn't be taking these trades, you know, because that's not the full formation. We want to trade the supply and demand formation properly, right? So I would be waiting for my high probability setup once it eventually breaks towards the upside, and this is my trading entry. As you can see, this wick over here, this is the perfect entry. Why? Push exhaustion, right? That little wick is the exhaustion back to the where? To the previous area of sensitivity. Look at this. Moving averages are pretty much crossing this candlestick over here, broke the 200 moving average. I also would use the Fibonacci line. So from bottom to the top over here, as you can see, that little wick is pretty much touching the 0.50 and 618 lines are sitting where the moving averages are. So this is my long position. Our stop loss is pretty much covering, all of these moving averages, all of the supply, which became a demand zone over here. And this is a perfect trade. Now for the target profit, we want to measure the bottom and the top of the channel. So 125 pips. We put it just here where the breakout happened, and we can then drag our target profit, something like this, which is pretty much just simply retesting the top and bottom of this wick. As you can see, target profit, target profit. So this gives me 2.62 risk to reward ratio, and this would have been a beautiful trade towards the upside. So again, a nice push towards the upside, bullish engulfing candlestick, by the way, so it shows a lot of institutional pressure. Boom, exhaustion back where? To the previous area of supply, which became demand now. Our stop loss is covering all of moving averages and the Fibonacci line. That's a ton of confluence for the trade, shooting towards the upside very, very nicely. On top of that, for my confluence, I like to use pivot points as well. So this is a pivot point indicator, and as you can see, this floor pivot point is also in this area zone, which adds just another layer of confluence for this trade success. So it's high probability, and this is the best way to trade these formations. It doesn't have to be, the textbook way where I showed you like a push, something like this and a continuation. It doesn't have to be. It can, be like this. It can be like this. Once you learn a little bit more about trading, trust me, you're gonna see these patterns all of the time, everywhere. Even when you go outside and the buildings will start looking like freaking supply and demand. I promise you, once you practice this, you will know how to do it. But there's nothing easy in life. If you want it, you really have to fucking learn. I'm telling you, I'm trying to give you all my strategy as simply as possible, because it's not that easy. If I'm gonna give you the easy bullshit, you're not gonna learn. You're not gonna learn. You will be watching all these videos and never learn. I'm trying to give you, proper fucking advice that actually works. So fucking take it and, run with it. Now I'm going to show how my supply and demand trading strategy works on live markets. Here's 3 trades I took. So this was our first trade. We can see that we had our supply zone and demand zone just over here. There was a strong push towards the downside. That was the drop. A nice consolidation, and once again there was a breakout of this area zone. So once we had that little pullback, I entered my trade just over here because I knew that it's touching the demand area. Simple, right? Demand becomes supply, and we are expecting the trade to drop down. Now the trade moved slowly. It didn't do much, as you can see. Kind of pushed towards the downside nicely, made the new low definitely, and then it kind of pulled back a little bit, as I remember. There we go, it pulled back over here. I was not scared, to be honest, since my demand, I knew it's gonna become the supply. The Fibonacci is there, the moving averages are with me on this trade. Was not scared at all to hold this trade for a nice $300 profit. This was a scalp trade. Yeah, very easy, nothing to really complain about. Eventually, it started to dip down. As you can see, pushed up a little bit again. It takes some time, it doesn't have to be instant. Sometimes it is, sometimes it's not. Then eventually started to push down. As we can see, boom, it's nearly touching it. And there we go, it touched my target profit low. That was the trade. Let's move on to trade 2. So here's what trade 2 looks like. I just entered the trade. It started pulling back nicely. So the idea behind the trade is similar, but this time I'm trading off pretty much the demand area just over here. We have our supply area here. We had a nice push towards the upside and a kind of consolidation, right? Since we are following the moving averages of 20, 50, and 200 over here, which is about to cross over, which means it's nearly a golden cross, which gives a bullish sentiment for the trend to continue. We also had the Fibonacci line pretty much touching our demand area as well, so I knew likely that there is going to be a lot of buying pressure, and I was confident in this trade. So this is not a formation trade for those who are curious. As you can see, it's a push exhaustion. We are simply trading off the demand area in this case and following the overall market trend. So let's see what happened. We are just moving the market, boom, goes towards the upside. It doesn't have to be fast. Boy, is it like $300 profit? Look at that. Continuing on, will it actually reach? There we go, it actually reached just over here, $467 profit. And I can even show you a trade we placed with my VIP members. This is USD Swiss franc, but I believe Euro Swiss franc. This is where we use supply and demand. As we can see over here, we have the demand, supply zone. We're currently bouncing off this area level. This is where I entered my trading position. It was a little bit late. I wanted to enter just over here with my trading members, but of course, if you take a look at the daily time frame, you can actually see this much more clearly. And because the trend or the overall market direction on the daily time frame and all the higher time frames is towards the downside, I'm willing to bet that this bearish trend will continue. So yeah, this is my full supply and demand trading strategy, step-by-step course. This is exactly how I approach the markets every single time, from identifying the zones to finding confluence to managing my trades and risk. If you got value from this video, make sure to give it a like, and I would like to invite each and every one of you to my Forex trading group. We've been making a ton of money. If you want to learn more about trading, I recommend watching this video next. And yeah, peace out, Lion Army. Take care and goodbye.